Hey everybody, it's Dave Miller here with Prime Mortgage, a division of the Business Bank. I want to welcome you to a sneak peek of my 2011 economic forecast. As real estate agents, financial advisors, and consumers, I'm sure you're all interested in getting a sense of how 2011 is expected to shape up. Well, this forecast is brought to you by a culmination of several friends who are industry experts, including the folks at the Mortgage Success Source, as well as experts like Knight Kiplinger, Frank Notehalf, the chief economist at Freddie Mac, Bob Wiedemer, very noted author and financial forecaster, Rick Sharga, a real estate market expert, as well as Jim Milano, compensation expert. So let's start cooking. I want to start by giving you a quick overview of what we're going to talk about. So in this video we're going to spend a few minutes talking about what we can expect for the economy in general. Obviously this is something that's on everyone's mind. We're going to spend a few minutes on what to expect in the stock market as well as the labor market. Next we'll discuss inflation expectations, the housing market, and then we'll wrap up with our interest rate forecast. Now if you're a real estate agent or a financial advisor, I really urge you to shut your door, turn off your phone, close out all applications, and focus with me for the next several minutes as we equip you with the information that you need to set yourself apart from your competition and be known to your clients as an industry expert yourself. By the way, this is the beginning of what you can expect from me to offer value to you in your business. I'm going to start sending videos to you on a semi-regular basis to help you grow your business. I'll be discussing things like mortgage guidelines, mortgage products, marketing tips and tricks. I'm going to show you how to do things like using Craigslist to literally fill up your pipeline with qualified buyers, as well as how to separate yourself from your competition in a listing presentation so that you never lose another listing again. I'm also going to show you how to use Facebook to get leads without irritating your Facebook friends in the process. I'm going to show you how you can duplicate yourself a number of times over through the use of a little-known secret that I've been using in my business to be more productive. I'm so excited for 2011. I truly believe 2011 will be my best year in the mortgage industry. I hope you'll join me for this great journey. So with that, let's get started on the forecast. So we're going to start out by talking about the economy in general, starting with the GDP, the gross domestic product. We're coming off a decent year, believe it or not. In the last quarter of 2010, we saw 2.6% growth. For 2011, the expectation for GDP is in the high 2s to 3%, which is a bit higher than recent expectations, and this is primarily due to QE2. When we look at the passage of QE2, or the second round of quantitative easing, it is stimulus to the economy. That, coupled with the passage of the Bush-era tax credits, is also a measure that should help push the economy in the right direction. So what is QE2 exactly? Well, QE2, or quantitative easing, quite simply is when the feds literally print money to buy bonds. So why would they do this? Well, they do this for several reasons, one of which is to push up the price of stocks. Number two, they want to lower the unemployment rate and help create inflation by devaluing the dollar. Now, they're not going to tell you this, but that's really what they're trying to do. Why would they want to devalue the dollar? The reason is real simple. They want to lower the price of our exports to make our products more attractive to the rest of the world. This in turn helps bolster production, which in turn is designed to help create jobs. We all know it's the jobs market that will help turn the real estate market around. So there definitely is a method to their madness. They won't say it, but this is their goal with QE2. It's not to keep long-term interest rates low, but rather to drive up stock prices, create jobs, which in turn should help the housing market and the economy in general. With more jobs and better performing 401ks and IRAs, this should bolster confidence in the American people. A confident consumer is a consumer that will spend money. So let's break this down a bit and take a harder look at the stock market. Let's start by looking back at how the stock market performed in 2010. 2010 was a great year for stocks. The Dow up 11%, S&P up 13%, NASDAQ up nearly 17%. So a pretty darn good year for stocks, with the majority of those gains coming in the last half of the year on the heels of QE2. So based on the goals the Fed have with QE2, so far it's been faring pretty well in terms of gains in stocks. Now for 2011, we feel we will continue to see growth in the stock market. Perhaps not at the levels of 2010, primarily due to the fact that everything's starting to stabilize a bit. So the expectation is that while there will be continued growth in the stock market, it's probably not going to be at the wild gains we've seen in 2010. This should translate into more hiring as well as an increase in consumer demand. At the end of the day, the buying sphere for the consumer should step up. So in general, we'll see the economy continuing to expand. We'll see investments starting to stabilize. We'll see dollars tending towards stocks rather than bonds. The stock market hates uncertainty, which is generally a benefit to bonds, which lowers interest rates. So as stabilization improves, this should affect the bonds and result in a slight rise in interest rates over 2011. In particular, the feeling is that energy stocks should fare very well with the increase in oil prices. Steel producers and global companies that specialize in high tech should also do very well. Why? All you got to do is look at China and India. These are huge countries with huge populations and with GDPs of over a staggering 8% right now. Think about it. We just talked about the U.S. At 3% GDP, and these countries are at 8%. You can bet there's going to be a large demand for infrastructure in those areas. Let's switch to the labor market. Obviously, it's going to be the key to the housing market, as we've already indicated. One of the main reasons the housing market has had such a difficult time in the past couple of years is, of course, due to the jobs market. If you don't feel good about a job, the last thing you're going to do is go shopping for a home. But the good news is the trend is starting to improve. What we look at is the weekly initial jobless claims that comes out every Thursday. The thing we're looking at here are the trends in the claims. Right now we're at around 400,000, which is not a great number, obviously, but it's definitely an improvement from where it was at for several weeks, which was about 450,000. The unemployment rate right now is about 9%. It wouldn't be surprising to see this drop down a little bit over 2011, under 9%. Now in 2006, we were at a 6% unemployment rate, and at that level, we had to create a lot of jobs to sustain that low unemployment rate. We're just not doing that right now, which means the labor market is going to continue to be a strain on the economy for a while. Here's something you should also take into consideration as you look at the unemployment figures over 2011. It's possible you might actually see the unemployment rate go up a bit. The reason is that there's a segment of the population that's not currently being counted in the unemployment numbers called discouraged workers. Basically, they're just so discouraged they're not even looking for employment. So as things begin to improve and stabilize, these people will re-enter the job search and be recounted in the unemployment numbers. So this may actually cause the unemployment rate to tick up a little bit. Don't be too dismayed by this if this happens in 2011. It's also really important to talk about inflation expectations. We've touched a little bit on this already. First of all, PPI, which is Producer Price Index, or wholesale inflation, is an important number. One of the things that we watch on a weekly basis, and right now it's starting to tick up a bit. It was up 0.8 for the month of December, which is an enormous rise. But because the economy is moving so slowly, and because consumer demand is so low, those prices that businesses are paying have not trickled down to the consumer yet. But that could change as the economy continues to stabilize and expand, and that's one way inflation could tick up in 2011. The other thing that we look at is all the money the feds are printing for QE2. This is highly, highly inflationary. The feds have been successful in taking us from a deflationary environment, and now we're beginning to hear more about inflation. All you have to do is take a look at gas prices to know that inflation is starting to be a factor. That said, this year, inflation is not going to get out of control unless we see some really strong economic reports, especially related to jobs. Because again, if you're feeling good about a job, you're probably spending money, and also creating demand, which is what is lacking right now. So expectations are that inflation should stay in the zone of about 2% on core year-over-year PPI. Think of inflation as an ocean and interest rates as a boat. As inflation, or the ocean's tides, rise, interest rates, or the boat floating on the ocean, have to rise as well. In other words, interest rates must always be higher than inflation in order to compensate investors. As we've already talked about, the housing market is very closely tied to the labor market. Overall, we feel there may still be a slight decline in some areas, particularly those most hit by unemployment. Areas like the Twin Cities should fare pretty well due to our diverse labor force and pool of employers. Overall, prices will continue to stabilize and may even improve during the second half of the year. There will still be a higher number of foreclosures, but on the upside, there should also be a large backlog of purchasers waiting to buy a home. We feel that as things do stabilize more in 2011, we'll begin to see these potential buyers not necessarily jump off the fence, but may begin to lean a little heavier to the buying side and should help prop up the housing market a bit. What's important for home buyers to realize, and the message you need to get out to them if you're a real estate agent, is that rates and home prices will begin to increase, so they should not wait any longer to buy. It will only cost them more money down the road. Now rates. Again, we've already touched on this a bit, but to reiterate, rates should remain low for 2011, but will begin to inch up over the course of the year due to the aforementioned factors. Two factors that could help rates stay lower longer is, number one, if the Feds are unsuccessful with QE2, but so far it doesn't look like that's going to be the case, or if things worsen dramatically in the Eurozone. This will drive money into U.S. bonds. But don't bank on either. Overall, we feel the trend will be for rates to move gradually higher and end the year in about the 5% range. Rates never go up or down in a straight line. There will be continued volatility, so if you're a consumer, lock your rate when your loan officer advises you to do so. If you're not getting advice from your loan officer on what's going on in the marketplace, you might want to consider working with somebody who has a good handle on what's going on in the marketplace. 2011 is still expected to be the third best year for interest rates, right behind 2010 and 2009. But throughout the volatility, rates are still great, and smart consumers will lock at a low rate and not look back. Here's a quote by Ed Carnegie, an MSS faculty member. Pilots often say it's better to be on the ground wishing you were in the air than in the air wishing you were on the ground. Similarly, Ed says you need to help your clients understand that it's better to be locked and wishing you were floating than floating and wishing you had already locked. Thank you for spending some time with me today. I truly hope this information has been helpful to you. Remember to watch out for more videos from me in the near future, packed with valuable content on everything mortgage related, as well as all sorts of marketing tips and tricks, as well as productivity tips and tricks as well. And please, if you know anybody at all that has a need for a mortgage, whether refinancing or buying, please refer them to me. You can always reach me at 952-258-8386. Until next time.